Today I'm talking about RSUs. My name is Ryan Shepard. I'm a partner with Knight Riley Shepard CPAs here in Fairfield. And we're talking about RSUs today. It's a very common form of payment that happens between a company and its employees. It's another form of payment, a way you can pay employees via stock or equity awards in lieu of compensation. So here's how it works. Basically, an executive of a company is paid salary, and they might also be paid restricted stock units. Restricted stock units are, think of it as stock certificates. They're here for you, but at the same time, they're restricted until a couple of things happen. One, either you have certain longevity within the company, and once you meet those longevity periods, the stock becomes yours, or there's performance type equity units that are based upon performance of the company or your department or whatever it might be. So what happens is these awards are issued to you, but you don't have the stock yet. Once they actually vest, meaning you've earned it, the stock is then transferred to you to your own stock account, your own custodial account. At the time that happens, that's when the stock becomes taxable to you. And it's taxable to you at the value of the stock on the day that you actually vest and you receive it. So that's when you actually will pay tax on it. So it's another form of compensation. The way it works is once the stock is transferred, as I mentioned, it becomes taxable to you. So you actually see that in your W-2. When you go to file your taxes, that's all going to be grossed up in your W-2. Well, how do you pay taxes on that? Well, at the time of the vesting, your employer is required to withhold at a statutory rate. That statutory rate per law right now is at 22%. 22% for most of these cases is inadequate withholding. So you're going to want to get with your CPA or talk to your advisor about what to do in a case like that. If a good chunk of your compensation is paid via restricted units, well, you're probably going to have a little bit of a shortfall because of that withholding. 22% in many cases just not going to cut it. So you're going to want to have that conversation. But nonetheless, they're required to withhold 22%. That can be done a couple of ways. One is the employee cuts a check back to the company for 22% of the value of the stock that vests on that particular day. The other way is the company can sell basically 22% value of the shares and then remit the withholding from that. And instead of you having to write a check. So instead of getting, say, 100 shares, you may get 78 shares. That's going to cover the tax liability for the federal side. And that's how you can do it. Now, keep in mind, though, whichever way you do it, whether it's stock or cash, you're likely going to be short simply because of the 22% statutory rate that I mentioned earlier. So let's say that's all said and done, right? So now you have obviously cash from your salary, wages, but now you have the stock that you've already paid tax on. So how does that work when you go to sell the stock or you want to liquidate the stock for cash? Well, now it switches to what's called capital gain property. Now, capital gain property is taxed totally differently. When you go to sell the security, there's a couple of things you have to look at. One is the holding period. So if the holding period is under a year, you're going to pay tax at your ordinary income tax rate. Now, you may ask the question, well, what's my cost basis in something like that? Well, that's a great question. The cost basis for restricted stock units is whatever the fair market value was at the date of vesting. So in other words, there are basically two things that give you cost basis. One is physically paying for something, right? You go out and you spend $30 on GE stock. Well, you have a $30 cost basis in GE. Well, in a case like this, your cost basis on restricted stock units is what you pay tax on. So it's the fair market value of that stock price at the date that it vests. So that's your actual cost basis. So Once we've established that, then we go to the holding period. The holding period starts at the date of vesting in that example. So if you have a short-term holding period, 12 months or less, then you are going to be subject to what's called ordinary tax rates, which is basically the same rate that you pay on your wages and interest income and that kind of thing. If you hold it longer than a year from the date of vesting, well, then your capital gain is subject to preferential rates. See, Congress encourages longer holding period of securities and stock. And there's a reason they do that. It's good for the economy. It's good for a lot of things. So they give you a preferential rate. So in many cases, at least, many of our clients, that long-term capital gain rate effectively counts to about 23.8% at the federal level. So let's say your ordinary tax rate is 37%. On a short-term basis, that's what you would be paying, 37% capital gain on the difference between what you sell it for and your cost basis, which, remember, we've already established that your cost basis is at the date of the vesting. For long-term, it's the same thing. Your cost basis is the value of that stock at date of vesting. So when you sell it past a year, well, the difference is that gain, you're going to just pay tax on 23.8% at the federal level, and then, of course, your state tax on top of that. So those are a couple of things just to think about with regard to restricted stock units. There are certainly other things to think about, such as the vesting period and planning for that, and also planning for what's going on in Congress and what's going on in the tax law. As Congress continues to modify the tax code, these things change all the time. So every time there's a change in tax law, well, it changes how we advise our clients. So lots of things to think about, but hopefully that helps with regard to a little bit of explanation on the restricted units. So thanks.